Hey guys, Martin here again. Just wanted to come back to you on an update since my email and video last week. Just update about what's happening in the world with the markets. If you've seen the news, the coronavirus and the share markets continue to make headlines for good and bad things. So, what's happened since last week? There's been a few more outbreaks in Italy, in Europe, and bits and pieces like that, which makes the world a bit concerned about what this might turn into. The Australian government or the RBA dropped interest rates, with the markets liked, and then things have changed and there's happening stuff overseas, so there's still volatility going on. So I just want to give you an update on where I see things, and what I've included in this email below is some extracts for some kind of key market players in the space. Some stuff there from Vanguard, BT and T. Rowe Price, just some extracts of some articles I've been reading about their thoughts on the market. I suppose looking at that stuff, it kind of really cements in for me a few ideas, which is A, we need to stick to the plan. There's a good line in there from Vanguard, which I'll just read to make sure I get it right, but you can read it below, which basically says, an investment plan established in calmer times should not be abandoned in the midst of a downturn, which I think is true to the fact that if we're comfortable with this plan we stick to, and it's good in the good times, well, it's going to be good in the bad times. And that's 100% the philosophy I believe in. When I set portfolios up for you, I set it up so it's based upon that it can survive through these kind of times. I've spoken to you many times about the bucket approach, how we have money in different portfolios and what that means, and why we aim for that 5-year buffer or even more. It's exactly for times like these. Because as I've always said, I'm sure you heard me say again, there's two ways to lose money in the share market. You either have to sell or you choose to sell. I'm confident that no one I looked after is in the have to sell bucket. What that means is they don't have to sell this money to pay off a loan. They don't have to sell some shares to fund their retirement. They don't have to sell some shares to give to their kids or whatever like that. They don't have to sell to meet their pension payments. We've got things set up so we take away that have to sell for at least 5 years. So that should give us the peace that we don't have to sell. A lot of people have to sell because they're too aggressively invested. They've got loans set up. They're trying to make a lot of money quickly and set themselves up for retirement. That's not the space we play in. I'm conservative by nature, and therefore I want to take that off the table, which should give us some peace and calm. The other part is the choose to sell. And that is the thing that's tested in times like these, where, okay, I understand the theory, but I just don't feel comfortable about it. Now, that's where it comes down to education, sticking to the system, going through this stuff, and most of the stuff that we've set up has been in place for a long time. We've enjoyed some great returns. This volatility has really only been going on for a short period of time, and history shows us that it will go on for a short period of time, but it will recover. The reason why it's been as volatile as it is because the world, from a health perspective, from a financial perspective, is just not sure what this is going to be. And what happens then is when there's a bit of unknown, there's a bit of uncertainty, all the markets revert to worst case scenario. What is the worst thing that's going to happen? And they're kind of saying, well, this is going to be a global epidemic. It's going to spread everywhere across the world. Everyone's going to be affected. Everyone's going to be in shutdown. Everyone needs to go and run out and buy their toilet paper, all that kind of stuff, which I haven't, don't worry. That's what the markets are pricing in. Now, is that going to happen? There's a chance, for sure. I'm not going to predict that it's not going to happen, but that's what the markets are pricing. They're already pricing in the worst thing that could happen. What I've got below, and what BT have come up with, they've come up with effectively what they think are 4 likely scenarios. And it's included below, but I'll also reflect on that. And basically, number one is what the market's pricing in. What they're calling a widespread global pandemic. What that means is, like I said, everyone in the globe gets affected, and not small numbers. Like, I know Australia's got some, but I know lives have been lost, and I'm concerned about people's health and that kind of stuff. But on the big scheme of things, when you compare the numbers to other health concerns, heart disease, cancer, suicide, the numbers really aren't that significant in that respect. I'm talking about thousands, tens of thousands kind of lives being lost in Australia. That's what the market's trying to price in. If that happens, they do think that potentially the world will go into recession, that people won't travel, people won't spend, all that kind of stuff. And I think that's what the market's really pricing in. That they effectively said that markets could fall further. If that happens, they think, and what would happen is interest rates would fall. Interest rates can go to zero. Interest rates can go to minus. So at the moment, they fell last week to 0.5. There's a chance it might fall again next month. If that happens, interest rates would go all the way to zero, which means if we took our money out of the share market anyway and put it in cash, we're not getting any return. Whereas at least we're still invested, we're getting an income. Now I know the price isn't what it's meant to be, but our focus always is what is the income, what is the portfolio producing. We know the value changes. In retirement, what we want to do is we want to live off the income. We want to preserve that capital. If we go to cash and there's no income, we don't have a choice, we have to eat into the capital. So that's option number one. Effectively, that's worst case. They say the likelihood is pretty low, but that's what the market's kind of pricing in. At the other end of the scale is a quick resolution. Medical breakthrough comes through in the next week or two, all of a sudden it's cured, it's fixed, it's over. The markets would bounce back very quickly. 20-30% return in the markets and we're back to where we were. I think, and they think, that's also unlikely. Probably as unlikely as the first option, that's not going to happen that quickly. Who knows? But probably unlikely. What they've got effectively are 2 or 3 options. Again, it's in the email. Rolling outbreaks globally or a mild outbreak, which means that there's an outbreak, the market recovers, there's an outbreak, the market recovers, that kind of thing, and it just kind of continues. It still might mean the government steps in and introduces projects or interest rates go down or something like that happens, but it happens on a more gradual basis. And potentially it takes months, years kind of thing. Again, we don't know exactly what it is, but the market's always based on the worst thing. They're saying potentially if that happened, option number 2 is the market still could fall a bit further, but would likely recover by the end of the year, if that's the case. A milder outbreak means that potentially it's cured or things kind of fizzle out. There's already reports from China that the diagnoses are reducing, people are returning to work, factories are opening again, and that's kind of starting to return to some kind of normal in that space. So, and I think either of those scenarios, the markets would recover pretty quick in that space. So, again, we don't know, I'm not here to predict the future, but kind of have a look at that. It kind of gives it the potential outcomes and what that might look like. And I'm confident the market is factoring in the worst case. If that happens, well then there's nothing we do about it, we're already there, we wouldn't change anything. If it's one of those better cases, well then the markets will respond pretty quick. This isn't the first time. When I entered in the financial planning space, the investment world was right before the GFC. We saw the markets lose 30, 40, 50, 60% in some cases. And we've lived through that. I've got some grey hairs from that, learned some lessons, which is why I've set things up for you as I've done now. But we know that will come and go. That was arguably worse, way worse, because companies were going bankrupt, everyone was over leveraged, there was big concerns happening again, and the world recovered, the markets are well above where they were then. This is different, this is more health related, and really the concern is that people will stop spending, stop travelling, that kind of stuff. That will kind of only happen for as long as this goes on for. So if it's only a week or two, will the market recover? If it's only a month, will the markets recover after that? The baseline is they're not concerned that your Woolies or your Coles or Apple, that kind of stuff, are actually going to go bankrupt. That was what the GFC was focused on. This is more, are their profits going to be down for a little bit of time while this is happening, while this is going on? There's a chance that they will. But again, that's what the market's already pricing in. So that's kind of the main focus I want to touch on. I think that's basically it. Vanguard, as I said, we have a plan, we stick to it. Now, I'm confident the way we set up our portfolios in that we can do that. This is a very short period of time so far. Most of the portfolios, if not all, are set up with a 5-year buffer. So we're only about 2 or 3 weeks into this thing. So we've got years and years and years to run for the market to recover. We don't need to recover in the next month or something like that. So we can rest assured that you're not going to have to worry about that. I suppose the biggest messages I can say is that in trust, reach out, give me a call. I know I've caught up with a few of you recently. I've got more coming up, reviews. So book them in, schedule them, catch up, talk about our concerns. If you've got any questions about your portfolio or what's happening in the investment marketplace, reach out, pick up the phone, give me a call. I'm on deck, email, whatever it is. Please reach out. A concern shared, but lessens the load. So please do that, and let's stick to the plan, because we know that it will work, and we'll look back upon this in a few months or a year or whatever it is and go, I'm glad we stuck to that plan. I'm glad we did that, because it was a much better outcome than other options. So thank you. Have a good Tuesday. Talk to you soon. See you guys.